Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. The case for a chat for our guest, who is Mihir Vora, CIO of Trust Mutual Fund, is whether earnings will live up to the kind of valuations that we are trading at and whether we can actually bump up higher from there. So that's the first point, of course, you've got to keep in mind for whether Q1 results can deliver the positive surprise. Talk a bit about power and the whole argument about renewables versus thermal. Is it renewables versus thermal, or is it renewables and thermal? Will capex pick up in H2, and therefore will private capex need to put up its hand, or will government capex be enough? I think all of these questions could well determine what the markets do in the times to come, and it's an absolute delight to have it Mihir Vora, CIO of Trust Mutual Fund, to talk about all of this and more. Mihir, great having you. Thanks for taking the time out. I hope all is well. A lot of people, Mihir, are a bit circumspect about the valuations that we are trading at, especially since it's an event-heavy month with both earnings, which is probably a seasonally weak quarter, as well as the budget lined up. What is your view on the markets currently?
Hi, good morning, Neeraj. Thanks for having me. I mean, the markets are where they are in the sense, if you look at, say, large cap valuations, they are still reasonable. I don't see any concern there. Then there are pockets of valuations and, especially the low floating stock category in the small and mid caps, where there is a bit of a froth build-up, and I would be very careful on those sides. So I think there is enough, I would say, juice left in the market as far as stock picking potential is concerned. But obviously the opportunities are less than what they were, say, 1 year ago or 2 years ago. So I think the core philosophy should not be forgotten, and we need to continue to focus on earnings growth, stocks where we see visibility of earnings growth, where valuations are still, relatively speaking, reasonable. And most importantly, do not go down the speculation path and do not go down the quality curve, in the sense we have certain, as an investor, certain benchmarks for quality of the stock, of governance, of the financials, etc. Just because something is optically cheap doesn't relatively cheap compared to the other stocks which have gone up a lot, does not mean we chase the next cheap stock. So I think not compromising on quality, sticking to the basic fundamentals. If you do that, there is still scope for stock picking in the market. As I said, there is a bit of froth in the small cap space, in the SME space, in the mid cap space. But overall, I would say large cap valuations are still reasonable, and we can pick and choose and build a portfolio.
Okay, Mihir, the question that comes to mind is some of the texture of this market, right? Globally, we've seen so many voices talk about how the US markets are expensive and the market is marching on to its own tune. Calling out tops has become so difficult. Is it, I mean, you of course look at long-term investing, but I'm just trying to understand, because you have a tactical mind too. Is it prudent to wait for the market to show its hand on the downside instead of taking a large cash call, even for a tactical trader?
Certainly, because the last 3 years have, if anything, they have proven is that it's wrong to take a big call on the market on the either side. So there's no point in panicking and selling if there's a sharp correction, and vice versa. There is no point in chasing when the markets are in a frenzy. So I think sticking to the middle path and taking prudent calls is more important. So we all know the markets are at new highs. So obviously you don't want to do lump sum investments at this point in time. And if you are fully invested, then obviously there's no harm in being a little more conservative and putting a little less money than before into the markets. If you're absolutely underexposed to the market, then obviously you can think of a regular or a staggered investment plan. But I think sticking to the middle path is the best thing to do, not take extreme calls.
Okay. So in a scenario like this with based on whatever you estimate the earnings to be as well, Mihir, and earnings not just for Q1, for the quarters ahead, but Q1 might just well give an idea of what could happen. Where is it that you are either constructive on at these valuations? Where is it that you are certainly away or completely bearish on, if not bearish, not bullish on when it comes to specific pockets?
Sure. So if I look at the growth versus valuation equation,
Huh.
a couple of sectors do stand out. One is financials, banks as well as NBFCs, where I think the underperformance has been there for quite some time. And for valid reasons, of course, there are margin pressures, liquidity has been tight. So even this quarter, you may see single-digit earnings growth on the PAT for the banks. Because the cleanup has happened, write backs have happened, so clean balance sheet. But there is a little bit of question in the short term as far as the margins are concerned. But having said that, the underperformance has been there for quite some time, and relatively speaking, this looks one of the most attractive sectors. I think a lot of people are underweight on the banking sector, so this sector does offer a pocket of relative value as far as growth and the balance of valuations is concerned. Because see, if the call is that India is going to grow at 7 to 8% in the next few years, then credit will grow at 14-15%, and credit has to be supported by deposit growth. So this tight liquidity situation is not going to last forever. Good thing is that we are seeing at least initial signs of the Fed, sounding a little more dovish than before. So this extreme tightness that we are seeing in the global situation, the winding down of the balance sheet, should kind of alleviate in the medium term. So banking and finance overall looks fine. Uh, I think the physical asset creation story still continues. Within that, of course, there are pockets where we have seen a lot of action. For example, capital goods stocks, especially mid and small caps, have run up quite a lot. So the attractiveness is to that extent a little less than before. But construction companies are still available cheap, and they have not gone up to that extent. And again, if you're going to create that physical infrastructure, you need construction companies to do well. So I think there are pockets, for example, like pharmaceutical stocks. They have done well, but again, given the growth potential, there can be some pockets of value there. So I think there is enough, sub pockets in the market where we are comfortable in, and that's where we would like to focus our attention on.
Yeah, and farmers had a heady move the last 2, 3 days or 4 days. Value plus expectations of good earnings. But Mihir, you made an important point about if India is to grow at a particular point of rate, then what could do well. The same breadth, people talk about how if India is to grow at 6, 7, 8%, power as a sector has to deliver. Power capacities have to get built out, supply of power needs to happen, generation will pick up, etc. And it's a big theme, expectations a lot about what could happen in the budget as well for the sector too. How do you think about this whole piece, thermal versus renewable, ancillaries within that, financiers and the valuations that each of these might be trading at? And what kind of exposures do you guys at Trust MF have within the power ecosystem?
So I think to answer your first question, it's everything and we are short of everything. We are short of transmission, we are short of distribution, we are short of generation, smart metering, everything, renewables, conventional, everything. I think we are short of, and the sooner we ramp up our power capacities, the better. China is approving 100 to 200 gigawatts a year of power capacity. I mean, it just boggles the mind where we stand in comparison to what China is building out there. So, the kind of catch up that we need to do and the kind of potential that is there for manufacturing and infrastructure creation requires so much power. And now this whole data center upside is something that we've not even factored in, say, 5 years ago. So to that extent, whatever you build will be consumed. There is a perennial shortage of power, I would say. So it's really a long-term story. So we are bullish on all aspects, frankly speaking, transmission, generation, distribution, and industrials in general is our biggest overweight in the portfolio, and that's because of all these factors.
Got it. And you believe, so in some people's argument that, let's say, some of the equipment suppliers, some of the power financiers, some of the other ancillaries, cable companies, etc., the argument people make is that they've run up a lot already. But if you, in your wisdom, are looking at a multi-year theme, has the run-up been so swift that it makes you uncomfortable? Or do you think that valuations are still palatable?
There is some discomfort at the pace of rise of the stocks, especially driven by the fact that there have been so many, I would say, thematic funds and sector-specific funds which have come up, which are driving these stocks up. So, and this includes not only the power sector, but the whole manufacturing infrastructure, including defense and all that theme. We've seen so many, a mutual fund specific, thematic funds, as well as in the PMS AIF space. So there is a bit of a, frenzy out there, and I would be a little cautious and be more choosy than before for sure.
Okay. Point noted. Mihir, stay on. So much more to talk about. I'd love to talk about today's key developments as well, and that would include autos, because autos are so much in news. It'd be lovely to get Mihir's view on the same. Take a quick break, viewers, and come back with more on Talking Point today. Stay tuned. Back with Talking Point in conversation with Mihir Vora. Autos are in focus. Lots of developments in the last 2 days. Maruti was buzzing on the waiver of registration fee of hybrid cars in Uttar Pradesh. Tata Motors and Mahindra offered discounts on SUVs. In fact, Maruti too has offered some kind of cash discount and exchange offers this month. Why have these price cuts come in now? Let me quickly get in my colleague Puneet to give some perspective first. Puneet, good morning.
Hi Neeraj, good morning. So essentially it's today is a gameplay of inventory as well as on hybrid tax cars, as you rightly said. Inventory has built up over the last 3 months as well, and OEM makers are expecting a better performance post Q1 as well, expecting a good kharif crop coming in for farmers as well to boost the rural demand for entry level as well as SUV going forward. Now specifically yesterday Maruti was buzzing today and it's continuing its momentum today for hybrid cars. The tax cut in UP could be a pivot for other states to follow suit as well. Currently Mahindra and Tata Motors both don't have any kind of plans to get into the hybrid space at the moment, and that could potentially be one of the reasons for Mahindra being at the lagging part. The only good positive thing about Mahindra is the strong order book that it has currently at 2.2 lakh units, including its top models such as Thar. As in yesterday, we have seen the XUV 700 price cut at the top variant, which could propel some more units. They've also been increasing the production per month as well. For Maruti specifically, hybrid tax cut was a long time coming, something on that to boost their demand specifically for the cars that they produce. Now we have seen that there is a 4 lakh rupee price differential between the petrol and the hybrid Grand Vitara, which is available in both variants. Now at 2.8 lakhs to 2.5 lakhs is what the on-road tax is in UP for hybrid cars. So that's effectively the 100% will be refunded or waived off for customers buying hybrid cars. So essentially good pivots for Maruti specifically and it's a long time coming because the stock hasn't done as well as M&M and Tata Motors. But it's be interesting to see if other people follow suit for the hybrid tax cuts. Back to you.
Thanks, Puneet. Mihir, lots happening in autos for a sector which is starting to see, everybody I thought was buying SUVs, and suddenly we now see price cuts coming there to inventories of 2 months, which FADA said is not usually seen at this time of the year. It usually comes in ahead of festive season. Is there an issue with demand?
There could be, too early to say, frankly, because the monthly numbers have not been so bad, at least at the reported level. But of course, there were these headlines of 60,000 crores of inventory that I saw a couple of days back. So that might be also weighing on the markets. And given the fact that auto had done so well as a sector in the last few months, maybe it's taking a breather. We also must understand that this year is a little bit skewed in terms of the wedding season. So, for example, there were hardly any weddings in the last few months, and even in July there are only a few days of weddings, and then again after August there are very few dates. So it's I think one of the years with the lowest number of days which are auspicious for weddings. So we might be seeing a little bit of seasonality impact because of that too.
Could it weigh in on some of the other businesses? Titan has had a slightly weaker than anticipated Q1 update, or in fact Kalyan was the only one which did well. Everything else, Senco Gold, Titan, etc., all have come off. So could all of that have to do with this wedding date piece that you spoke about, Mihir?
Yeah, I think it's that's possible because again, jewelry is a big thing for weddings, but the point is that it was frankly not unknown. We all knew that there are less number of weddings this year. So to some extent, it should not have come as a surprise. But anyway, when stocks do so well for so long, there is always some reason that you need to have a correction. But I guess there's just an excuse for that.
Got it. Actually, speaking of stocks which have done so well for so long, capital market plays, Mihir, have had a fabulous move. Now we see increasing regulatory scrutiny. There's a lot of talk of some margins going up in mid-cap, small caps, maybe some measures on the derivative side as well, which might all impact the incomes of the broking players. And then, of course, some of the others too have had some regulatory moves. They've had a very good run thus far. Is it time to be cautious on the sector, or do you believe the runway for growth is very long?
So the second part that you said, the runway for growth is very long, still holds. But when our industry is growing so fast, there obviously will be some regulatory interventions from time to time, and we've seen time and again in lots of sectors. Once the regulations are implemented, and there's some time that has passed, things come back to normal, because ultimately it's going to be a function of the macro trend, which is higher financial savings, and higher financial savings going into savings-linked products like insurance, broking, wealth management. So that macro mega trend does not change. From time to time, you of course have these events or incidents, but in the long term, frankly, things all work out.
Got it. And Mihir, one point, therefore, okay, so that well taken. My final point, and something that you mentioned at the start of the interview, but I forgot to ask you a follow-up, and that is on capital expenditure. Now, because everybody's juggling whether the government can do this troika of some consumer focus in the budget, fiscal glide path, and capex. I would love to understand from you, if the capex numbers remains the same as it was in February, will it be imperative for private capex to come up to carry on the capex baton, or do you think we can still have a decent capex drive for the country, even if private capex still misses the mark, let's say in the current calendar, and maybe comes back or comes to the fore or comes to the party only in 2025, if at all?
See, the government's contribution in the last 3 years has been immense as far as capital expenditure is concerned. So I don't think it's necessary for us to expect anything more than what the government has already done so far, frankly. The rest of the traction has to come from the private sector, and the government is doing all it can in terms of providing the environment for the private sector to come in. We had the corporate tax cuts in 2019, and we have PLI schemes in sector after sector, and it looks to be an open-ended approach where more sectors are always coming in, and the quantum of PLI is also getting revised. So I think the ease of doing business and facilitating, through PLI schemes, etc., is what the government can do, and what the government has been doing very actively. So I see more of that happening rather than the government itself going out and spending at the central level or the state level.
Okay. And Mihir, just 1 minute left for the show to end, but just wondering, you believe capex beneficiaries as a theme still continues, right?
It has to, otherwise there's no way we can grow at 7.5 to 8%.
Perfect. Okay. Great. Mihir Vora, thank you so much for taking the time out and being with us today on the show. Really appreciate your time.
Absolutely. Thanks for having me. Take care.
The pleasure was ours. That's Trust Mutual Fund. Mihir Vora, the CIO, talking about some of the aspects around markets. They're still constructive on financials. Without financials, he says, we can't continue the GDP growth that we envisage, as also for capex, the last point that he made. Well, that's it on this leg of Talking Point. Thanks so much for tuning in. Stay tuned to NDTV Profit.